We're going to talk today about investor loans. And this is, as I told you last week, this is a little bit interesting in the way that you can acquire a loan for an investor. So this is going to be kind of a combination of a little bit of training and a whole lot of marketing information, because I want you to have some tools that you can use to talk to people about. It doesn't mean that they're going to take one of these loans, but it gives you something else to be able to talk to them about. It gives me something else to talk about that hopefully demonstrates our credibility, and inside of that acquires us a new client. And then whatever they buy is fine, right? So we're going to talk about investor cash flow product this morning, which is a interesting product. So let's look at the way traditionally we buy property. When a person goes in to get a mortgage, the lender has to calculate their income and then calculate all their debts. So if you're going to buy a piece of investment property, we're going to calculate how much is that monthly payment on top of all of your other debt. Your house payment on your primary residence, any other investment properties, car payments, motorcycles, whatever it is that you've got, credit cards, we're going to add it all up, student loans, and that becomes your debt divided by into your income. Now we're going to come up with a debt to income ratio. Pretty basic stuff that you and I have talked about many times. Well, when you're buying investment property, a lot of people are in a situation that says, but Greg, if I buy the investment property, it's going to pay for itself. My monthly payment's going to be $1,000. I'm going to collect $1,300. If that's the case, then why can't I buy this property? Because it's really not going to come out of my pocket anyway. If you're going to get a loan from Fannie Mae or Freddie Mac, in that instance, they're saying, we want to know that you can afford to make this payment in the event somebody's not going to be living there. That's what they're going to look for. So in that instance, the debt to income ratio becomes very important. They require a minimum 20% down. The debt to income ratio has to be somewhere in the ballpark of about under 43%, versus traditionally we can go as high as 49%, but 43%. So this knocks people out in many cases of being able to buy a piece of investment property. So the non-QM, non-qualified mortgage market, the equity market, they came up with products that said, we're not going to look at all of that. As a matter of fact, when I look down my notes, this is very interesting. One of the things that I have highlighted in my notes, it says, no personal income or employment information is required. Whoa. We're not going to worry about that, because all we're going to do is look at whether or not this property is in fact going to be able to rent for more after they take out expenses, the little formula they use. Will it rent for more than what you're going to be making your monthly payment? Now, so one of the things that you'll hear this term, that's why I put it up here, DSCR. Sometimes it's just DSR. That's what you'll hear. That's the terminology that the industry uses. So I would familiarize yourself with that terminology. It's real simple, DSCR or DSR. All it stands for is debt service coverage ratio. That is what they're going to use to determine whether or not they'll give you a loan for that investment property. So if you're coming to me and saying, Greg, I want to do a Fannie Mae, Freddie Mac loan, then I have to use traditional debt to income ratio based off of income, debt to income ratio. The difference. Debt service coverage ratio, not debt to income, debt service coverage ratio. And in this case, what we're going to do, there's a little formula, and what they do is they take the net operating income and divide it by the monthly payment. Principal, interest, taxes, insurance, and association fees. And as long as that ratio is 1.0 or better, we're not going to worry about it. So there are some things, it's not just what the monthly payment is, it's not just what the rent's going to be. They're also going to, there's a little bit of a formula there. They want to know, whether or not that house is going to have expenses outside of the norm, and they take it into that account. So I usually tell people, look, as long as the income from the property is about 110% of what your payment is. So if your payment's $1,000, if it comes in at $1,100, you're fine. Now, here's the interesting thing. There's two different ways to look at this. If you're buying the property and it's currently not rented, how do we know what the rental is going to be? In that instance, we're going to order an appraisal, but we're going to get a rental appraisal. And the rental appraisal costs a little bit more money. Instead of the traditional $475, we're going to charge about $650, maybe $675, so a couple $100 more. And the appraiser is going to not only look at the comparables to see what the home would sell for, but they're also going to do the rental comparable to see what our property's renting for in this area. And in doing so, they're going to come up and say, well, hey, the property's valued at $250,000, and the rental for this is going to be about $1,600. And if your monthly payment is only going to be $1,300, well, you're in. Give you the loan. I'm not going to ask you what your income is. I'm not going to ask you if you're even employed. I'm just going to give you the loan in that instance. Now, you have to meet certain credit score requirements. How's this for credit score, though? This is almost to the point of ridiculous. Let me just make sure I don't want to say it without, because I look at it and I look at this and think, oh, really? Yeah, they'll do this for credit scores down to 600. They will also do it for as little as 10% down. Now, if it's 600 credit score, you're not going to get it at 10% down. But how's this for one? If my FICO score, if my credit score is over 700 and I put 25% down, not only am I not going to ask you for your income and employment, I'm not going to ask you for this. I'm just going to give you the loan.
Say that again?
Manuel, 1 second. Well,
just clarifying. If you're over 700 credit score, you can put 25% down.
Yes.
All you have to do is be able to find the house.
We're going to give you the loan.
Say what you said again.
If the credit score is over 700, and this is an investment property that you're buying, and you're going to put 25% down, we're not going to ask you for employment, income, or DSCR. We are going to get an appraisal, okay? You can't pay $500,000 for a home that's valued at $300,000, but we're not going to worry about any of this. All we want to know is that the home is valued at least your contract sales price.
If it's already occupied with a tenant, do they still order the rental appraisal?
No, we don't have to in that case. Jay's question is, do we have to get a rental appraisal? If there's a tenant in there, we can show that the tenant's been in there and this is what they're paying for rent.
That's a second appraisal?
What's that?
Is that in addition to so if there's no tenant, you have to get the rental appraisal. The higher price, does it include the purchase appraisal too?
Yes, right. We're still going to do an appraisal on the property, but we're not going to worry about this. We're just going to use the rent that we collect, that's been collected on the lease. Or
How many of these can one person do?
unlimited.
I have a property.
Unlimited. Isn't that crazy? It's just nuts. Now, don't go thinking you're going to get this loan for the low threes interest rates. These interest rates are going to range depending on how much you're willing to pay in discount points and origination fees. They could be as low as 4.5, could be as high as 6, and depending on credit scores and everything else. I would just simply think you're going to probably pay somewhere between 5 and 5.5 on your interest rate, and probably at least 1 point origination or 1 point discount, something in that ballpark. That's what it's going to cost to get this. It's not free. But when you think about it, I mean, I think 2 years ago, 2019, we were giving people loans in 2019 for 4.875%, and that was a good rate. Now we don't have to verify anything, and I'm still going to give you a rate for about 5.5 or 5.25 or 5. That's like, whoa. So this is a product that you can use, I can use, when we're trying to market ourselves to the community. And if they even so much as breathe the word investment, I could ask them a few more questions, and that would lead to, what do you mean? What are you talking about? If they ask that, I can then talk a little bit about this particular product. And if we're talking about this product, that might open the door for something else. So again, this is not that you can buy a buy a home that's worth $300,000 and pay $500 for it. It doesn't work that way. What it is, if you put down enough money on it and the home's valued at what the contract price is, we can give you a loan without having to ask any weird questions, as long as we're going to get rental proof that we're going to be about 100% or 110% of what the monthly payment's going to be. If we can do that, we're going to give you a loan. Now, I know some of you are wondering, like I do when I hear about stuff like this, is, Greg, how can this be? And it can, because right now, rents have gone up so much, and home prices are actually at a point that you can actually buy a home as your primary residence and do better than you can in a rental situation. And the institutional market knows that. So as a result, they're saying, as long as you can buy the property and we can cover the rent, we're good. You're going to get the loan. We're not going to worry about it. I know that might sound crazy, but that's how it works. And it's not a bad thing. Now, not everybody's going to get it. Not everybody is going to just be willing to put down, 20 or 25% or even 10% to go ahead and get a 5% or 5.5% or 6% interest rate. They're not going to want to do that. But potentially they could. So for you and I look at it as a marketing tool. What can we do to market ourselves so that we can make this a product, kind of like what you folks do with Easy Sell? I mean, not everybody takes Easy Sell, but isn't it a great tool to be able to just talk about? This becomes that availability. Yes?
So if you have a client that likes to flip homes, this would actually be a really good way.
Good question. If a client wants to flip homes, can they do this? Now, these loans come with prepayment penalties. When you get a Fannie Mae, Freddie Mac, USDA, FHA, VA loan, there are no prepayment penalties, not allowed. Qualified mortgages, QM loans, cannot have prepayment penalties. These are non-QM loans. These do not fall into that bucket. There are prepayment penalties on this. So can you do that? Yes, but you've got to deal with a prepayment penalty. Now, when you take this loan out, you can actually buy out of the prepayment penalties. You buy it out by paying discount points up front to get out of prepayment penalties. So you never really get out of it totally, Manuela, but you can. So a lot of people buy out of these because their intention is, I want to get this property right now. I just want to buy it. So I'm going to buy the property. I'm going to get it closed right away. I'm going to buy out. If I don't buy out all 4 years, I'm going to buy out 3 years, because my intention is to get a loan on it in a year or something, whatever it happens to be. So you can use it if you wanted to as a flip, but it's going to be more expensive because you're going to pay a fair amount of money up front to get out of the prepayment penalty. Make sense?
So the prepayment penalty, I heard you say 3 and 4, they're only there for the first 3 or 4 years?
Yes. The prepayment penalty lasts anywhere from 0 to 4 years.
So if you pay extra on the a mortgage, you don't wanna do that over the first 3 to 4 years, but then after that, you can.
After that, doesn't make any difference. After 4 years, doesn't make any difference.
What is the term of these loans?
What's that?
What are the terms of these loans?
It varies, so I'm not quoting what those are, because the question is, what are the terms for the prepayment penalty? Each investor that we sell these loans to offers something just a little bit different. So when that time comes, but you can figure it's going to probably be, if you want to buy it out completely, you're probably going to pay 3 or 4 points for it up front. So not cheap. They're going to make their money on this. The end investor is going to make their money on it one way or the other. Good questions. What else? How do you see that you could present this to somebody? I'm curious. Do you have anybody that you could even present this to?
I think everybody does.
What's that?
I think everybody has somebody.
Mm-hmm. Yeah, I think most everybody, I saw heads all nodding. We could probably invite it to someone that would say, oh my gosh, I could probably use that. Somebody who wants to get into that market, wants to get into start investing and be able to get the loan pretty quickly. You know, and one of the nice things I think, if I were I'm not doing this, but if I were, I like the idea of the 25% down, above 700 credit score, just get an appraisal, don't ask me any other questions. I love that. I don't mind putting 25% in, especially if my monthly payment's going to be $1,300 or $1,400 and I'm going to collect $1,800 in rent, and I already know that. Man, just get it done, make it easy. Whether or not I buy out the prepayment penalty or not, another issue. But if I'm getting a 5.5% interest rate and I'm still only going to be paying $1,300 or $1,400 a month and I'm collecting $1,600, $1,700, $1,800, who cares? It doesn't make any difference. It's all about how much money are you making after your monthly payment and after your investment. What they call cap rates. As long as my cap rate is where I want it, I'm just going to do this. What a simple and easy way to go about this. Other questions?
So I would assume that if somebody do go for the 10%, they should expect to be paying about 6%.
They're going to probably pay a little bit higher. It may not be 6, but some depends on credit score, Worrell. But they'll probably be paying closer to that 5.5 or above. Yes. It's pretty simple too. When we get a buyer who's interested, there's a calculator that we have. All we do is plug in the information, and it just gives us what the rates are. So there's no back and forth or anything else. This is the situation. This is the rate. That's what you get.
How long does it take to close? If you're not doing.
I would say just like a normal loan.
Okay.
Yeah, like a normal loan, 25 to 30 days. I mean, you can. You could probably do it. The challenge with doing it faster, at least in my case anyway, this is not a loan that we do in-house. This is a loan that we broker to one of 2 or 3 or 4 different companies. So we don't do it in-house. So what happens with this loan, when in my case, so me and Michelle and Melinda, Michelle, my wife, we get the loan ready, we get it disclosed, it goes to Melinda. Melinda sends it over to the investor, who's ever going to ultimately get it. They review the file. It takes them anywhere from, depends how busy they are, 24 to 72 hours, and they come back and say, we need the following items. And then we collect the following items from the borrower, then we go ahead and submit it back to them. When we submit it back, it can be anywhere from 24 to 72 more hours, and we still have to have an appraisal. So that's why I'm saying it's not as, like, I got a contract this morning from someone who we're closing on. Now, mind you, we got the contract this morning, and we have a holiday coming up. We're going to close on November 30th. That we can do because we do it ourselves. And we're not so overwhelmed with business right now, so it makes it a little bit easier. If this would have been June, I'd have said they're not happening. But right now, we can get it done.
2 weeks?
Well, actually, when you think about it, we've got 5 business days, and then we've got 3 next week. That's 8. and then 9 and 10, so 10 business days. And so, and we will make it. We will make it. You know, and that's an unusual one. But again, a case like that, we have such a good borrower. And, you know, give you an example. I spoke to this borrower. I get a call from the real estate agent at about 8 o'clock on Friday morning. And the first question the real estate agent says to me, he says, Greg, what time's your tea time today? This is on Friday, true story. And I said, 1:10. He said, I knew you were going to be out there. I said, it's gorgeous outside. Why not? It's Friday. So he said, I said, what do you need? He says, I got someone who wants to write a contract. I said, okay. He says, how quick can I get a pre-approval letter? I said, let me get on the phone with the borrower. If it's simple, we'll get it out right away. I get on the phone with the borrower at 8:30. By 11 o'clock, pre-approval was done. So you can do things like that if you've got a cooperative borrower. If I'm in the office. Now, if you said to me, Greg, can I get one by 2 o'clock today? I'd say no, because I'm going to lunch with 2 real estate agents today, so I'm not going to be able to do it. But I happen to be in the office before my tea time on Friday, so it worked. You know, Mike says, Greg, you shouldn't talk about your tea time. Why not? Everybody knows I do it. I'm old. I want to go out and do that once in a while. But anyway, just joking. But anyway, these loans, give them 25 to 30, probably closer to 30 days, just to make sure, because we don't control the entire process. The 2 investors that we primarily use do a great job, so I'm confident with them. It just takes a little bit of time. Other questions? Well, guys, thank you. I really appreciate it. Next week, we're going to talk about asset-based loans. This is for people who have lots and lots and lots of money in the bank, but they don't have income or income that they can prove. And these people can get a loan. As a matter of fact, they can get a loan Oh, by the way, one thing I didn't mention on this thing, you cannot do this on primary residence. This is an investor product. If you do not own a home today, you cannot get this product. You have to own your primary residence in order to get this product.
Meaning own, or the bank owns it?
Well, the bank. I mean, you're the title holder to the property, even though the bank may own it with you because of the mortgage. But this cannot be your primary residence.
So even if you're purchasing one that has a tenant in place already and it shows that there's a lease going on for a while, you still have to have your own?
You still have to have your own, yes. Still have to have your own. So next week we're going to talk about asset-based loans. The asset-based loans are phenomenal for primary residence. Outstanding. Especially if somebody who's got lots of money and no way to prove income. And we'll talk about that one. All right? Thanks.